jacket if you want. That's fine with me. We've got some other things coming up relatively soon. I want to give you a little bit of a preview of that. 9 o'clock, we will do the runner, and we'll talk a little bit more about some interesting developments on the insider front that I think are relevant and speculative and exciting. I promise I will not put you to sleep. Futures right now, oil price is dipping. Why not? Every time that there is a major headline or some major price squeeze, we just kind of roll right back over. Natural gas continuing to drop, and I am still very upset with myself because I legitimately called this last Friday and didn't short UNG when I should have. Lesson learned: when we hit overbought on the RSI, be the contrarian, ignore the weather reports, and go the other way. On top of that, silver hitting new highs, 63.25. Congratulations, JP Morgan, on your massive silver position as well. Platinum, palladium, copper, all across the board. Gee, I wonder what's driving that. We'll get into it. But why are you joining us this morning as always? Well, we had a major development yesterday. Federal Reserve cutting its Fed funds rate by 25 basis points. It is considered a hawkish cut because, according to the Fed dot plot, not expecting more than another cut next year. But the market, as what you've seen if you were following Don and I yesterday during that 2-hour marathon during the Fed, that the market doesn't believe it. The market is suggesting many cuts next year. In fact, the CME Fed report coming out for January already kind of in play for 22% on a cut moving out to March. You get to that 50-50 level. It really comes down to when and if there is a new Fed chair and that new regime. You could see the market pricing in through September at least 2 more cuts when you get down to the 3% level. That will be the line over the next couple of weeks. Agreed, it doesn't count unless you trade it. It's not a bad time. Well, see, Eric made it, so that's what matters. All right, we're green on the Russell. We're green on the S&P 500. And the figures are positive, but once again, there are some developments that are coming up in the next couple of days that are going to be very critical. And what is driving this? What drove that squeeze yesterday? Well, you're not going to be shocked to find out that the markets like stability. The markets like stability. Now, does it mean that we're going to go to 7,200, 7,500, 8,000 as projected by some other other groups on Wall Street? No, actually, the case for this will be the idea, the argument that this can lead to a range-bound market at least through the first quarter of 2026. And volatility is going to follow, largely because there are some air pockets in the liquidity world that are going to need to be addressed. We're going to talk about that momentarily. But for right now, we're green. We will react. We will see how this market opens. Energy prices moving lower today, but the metals moving higher. And it creates a little bit of questions about, are we going to see some rotation? Where is money going to flow? At the moment, as we're looking across all of the different sectors in the S&P 500 and across all of the sectors in the Russell, consumer defensive and utilities are the ones that are under pressure. Everything else looking positive. There is some underlying selling pressure in the Russell, but the selling pressure in the S&P 500 is not strong at all. In fact, we are down. I said this with Don yesterday. We're down to 2 stocks that are really in a breakdown mode. One of them is Netflix, which is getting beaten up badly because of this chatter around what's happening with this deal around Warner Brothers. Paramount sending a letter to WBD shareholders saying that they are fully financed at $30 per share, and Netflix is trying to find financing for this deal. The only other name that's really seen a significant amount of pressure and starting to wake up a little bit after that November 21st bottom is Super Microcomputer. So we are in this situation where it's nothing but optimism on the S&P 500, and that's across the whole board. That's across all portions of the S&P 500, less the defensives, which, once again, will be inverse to the technology stocks, and utilities, which are getting a little beaten up because of the hawkish expectations next year if you're not going to cut rates significantly. But again, the key thing to keep in mind right now is that markets from a momentum perspective are a tad stretched. They're not showing up in the RSI and MFI. They're showing up in the coefficient analysis, and they're showing up in the number of stocks breaking out versus the number of stocks that are breaking down. All right, so Mike Sass, wherever you are out there in the world, Mike Sass, is there a Mike Sass here? You've won the Federal Reserve's new terminology contest. They did not call it quantitative easing. They called it reserve management purchases. Reserve management purchases, not QE, not systemic purchase for long-term asset treasuries, splat, or bond acquisition and injection for liquidity, oversight, utilization tool, bailout, or quantitative easing 2, electric boogaloo. Reserve management purchases. Mike Sass, wherever you are, Mike Sass, table of 4. The Fed cut, the dot plot chaos, 40 billion RMP injection, markets whipsawed after a hawkish cut and, well, unrealistic expectations. I'll talk about that in a moment. But the Federal Reserve, Jerome Powell, doing what Jerome Powell does, came up with another term for something that is not quantitative easing. Now, it isn't technically quantitative easing because it's not long-term bonds and it's not MBS and it's not the actual definition of what Ben Bernanke called it back in 2011. It drives me nuts, and as I've compared this, if you've ever seen Romeo and Juliet, and Romeo says it is to the east and Juliet is the sun, and then someone from CNBC stands up in the back and screams, she literally is not the sun. It's the same feeling, the idea that we're getting too caught up in the literal definition of QE, because the only thing that matters is the outcome, and the outcome is financial stability. It is a liquidity injection. It is $40 billion a month, and oh, by the way, it is extremely convenient that the U.S. banking system needs about $3.3 trillion in reserves to function properly, and we're short about $400 to $500 billion in reserves. So injecting $40 billion a month, and I thought it was only going to be 20. Injecting $40 billion a month is a disguise of QE. It's QE light. It's QE-like. The only thing that matters is the outcome. It doesn't matter. It doesn't matter what you call it. Call it Steve. Momentum's extremely stretched going into Third Friday right now. And the point of all of this is that they are starting a program with a different terminology, and I challenge you to find a central bank policy that has ever gone away. They have acted as though, once again in their statement, that this could be temporary. QE never went away. Treasury support, Treasury QE, never went away. Repo support never went away. The bank lending program still exists. It's just, they'll probably change the name of that at some point. The reality is this: the Fed's real mandate is stability of the financial system. So they are going to do what they have to do, but I do get a little bit upset because if you put this into perspective, the $40 billion a month is 6 times all baseball salaries annually. They just made it up, right? Before I get to that little part of this morning, this is where the numbers really make no sense to me. CPI is magically set to 2% in 2028. They did this in 2022. They said we would be at 2% by 2025. We aren't. The GDP projections show steady growth without any volatility. The Fed funds rate forecast falls to 3% magically in 2028. This reads like a soft landing fiction drafted by people who are leaving. And they probably are, to go work at banks. I'm sure Powell will either run a college or get a job with PIMCO. It's what everybody else does. And the media will treat this as if it's reliable, and models will treat it as if it is reliable. But we know it's not. This is direct support for the repo markets and reserve balances. It is functionally identical to QE with a rebranding. The timing aligns with tax season. That's what's critical. They've effectively said, we're going to do this with a focus on April. Why? We just had a repo spasm. We just had a money market spasm take place last April. And what happens is when you hit tax season in March, money comes out of banks. Why? People pay taxes. This aligns with seasonal tax funding pressures, and the Treasury and the Fed coordination effectively is resembling deficit monetization moving forward. Why does this matter? Well, it's largely distortion. And we work for this money. We work for the same money that they magically create out of thin air, which is insane. So regardless, markets like capital, and this is direct support for the repo markets. This has been telegraphed for months. We saw the Dallas Fed talk about it. We saw Powell talk about this, that effectively the SOFR, the secure overnight financing rate, is what they're trying to stabilize with less focus on what's happening with the Fed funds rate. All right. Post-Fed bounce was driven by extremely thin liquidity. Don and I pointed that out yesterday. Breadth weak, sector divergence was increasing, the dollar rising, yields bouncing, risk on feels forced. This morning, looking at the dollar, we go to the UUP, you can see that we are down today. We have dropped under this, and that's going to be critical heading into next week, focusing on this dollar. Because if we do get a bounce, it can be signaling that there is an expectation that Japan is not going to cut rates. So we're going to keep a very close eye on the dollar. Momentum is actually, the breakout momentum is now at the same level that we saw back in October 28th. That is where our reading went negative for the Russell 2000. And tax loss selling, if this market and sectors are down, that would probably start to coordinate next week. That puts our attention into next week. Now, I am not going to chain myself to the desk, and I am not getting up very early in the morning to focus on the Bank of Japan report. I do not speak Japanese. I do not understand any of it. So I will wait for someone else to tell me what the hell happened. But that said, markets will continue to pricing in a Bank of Japan hike next week. That is where the volatility can kick in pretty quickly, largely because a hike would strengthen the end and potentially unwind that carry trade a little bit more. Global yields would adjust sharply as well. Remember, this is a major period of time where there is a regime change that is transpiring. We've had decades of loose monetary policy in Japan that has enabled a lot of cross-border capital flows here to the United States, that has provided a lot of valuation expansion, which has been followed by passive flows and leveraged hedge funds, and basically stocks going up and not justifying their valuations. And when that happens, if Japanese yen goes higher and we start to see people unwind these trades, that can lead to a cascading effect that is very violent. We've already seen a preview of that. It happened in August of 2024. Japan had its biggest downturn in its equity market since 1987, but all major equities in the U.S. got pulverized, particularly the Magnificent Seven, in a period of about 5 days. So we have to pay very close attention to this. This is the single biggest risk in the global financial system in the next week and a half. I don't care what you say about Venezuela, and I don't care what you say about the Baltimore Orioles signing Pete Alonso. Oracle has missed again. This is the last thing that we will talk about before we get over. Why not? No, it's not. Oracle down 13%. Not good. And they're trying to spin this wherever they possibly can, right? This idea of AI-powered personalized energy insights to millions of customers. Yeah, why don't you just come to my house and explain to me that I am paying too much for electricity? Thanks. I don't really know what they're trying to spin this morning, but again, Oracle is under a lot of pressure. The stock has absolutely been pulverized in this repo negative momentum environment that we had seen heading into November. Oracle miss sending tech a little bit lower. AI infrastructure spending escalating faster than revenue. That is a huge red flag. NVIDIA, Microsoft, Amazon, Broadcom pulling back in sympathy we've seen in recent days. NVIDIA down this morning and just kind of hovering near these key levels. Don pointed this out yesterday when we were watching the final 2 hours. Microsoft was selling off yesterday. So what did the market know? What was kind of simmering under the AI trade while everybody was so hyper-focused on what was happening with the Fed? This is the first real profitability scare in this AI cycle. And as we noted, there is going to be ample, or at least ample support, some support, for the repo market for bank reserves into April. The Fed is still signaling, though, that there will potentially be some problems. And I want to point this out. When there are problems in the repo market, when there are problems where the SOFR, the secured overnight financing rate, is higher than the Fed funds rate, that's where we can have these spasms. And the spasms lead to deleveraging in names like this. We saw this happen already. People wonder, why did the Magnificent Seven go from 768 down to 62? It doesn't seem like a big move. It is a huge move, a 10% move for Magnificent Seven stocks in a month with a slow bleed off. And if you go back to March and April, where we had a catastrophic downturn, right? 55 on the Mag 7 to about 38. Why does that matter? It matters because what's happening is those are the equities that are unwinding, where all that leverage positions operate. So what can happen is you have a bad number in Q2, Q1 earnings, Q2 earnings. Basically, Microsoft misses. There's a problem going on in the repo market, and then all of a sudden, all this stuff just goes all at once, very quickly. And that's probably what's going to happen in the next 2 years. I'm going to say next 2 years, and I don't mean it because I know everybody wants to trade for today. I am the scout. I am the guy on the horse going out 50 miles to see what the hell is there. And the reality is we're going to have a refinancing issue in about 12 to 18 months. We're going to hit some problems post-April. We are at the top of our liquidity cycle right now. So resultantly, yes, we can hit all-time highs heading into Q1 to Q2, but the reality is that this is going to flip, and eventually we're going to hit a quarter where the profitability scares really accelerate, and it happens not gradually. It happens all at once. So just be aware that as we move deeper into 2026, there are going to be very significant swings in these top names. We are likely going to see a cycle that is very common, but also very similar to 2022. Just a note, gold real assets are moving higher. And again, stealth QE, doesn't matter how you want to call it. Japan pumped money into the system 2 or 3 weeks ago. Gold hitting highs, RMP new highs on, not here, I believe it was on the London exchanges. RMP is interpreted as stealth QE. I was supposed to write this. I wrote gold because I'm doing too much at 6 o'clock in the morning. Silver hitting new highs as the RMP interpreted as stealth QE. I think gold hit a high on the Shanghai trading. Silver trading above oil on a per unit basis. Bet you never thought that was going to happen. Real assets are rising as a hedge against continued monetization. And again, that is the true story. It is the quote-unquote hedge of tomorrow that we have talked about. Liquidity wave plus a deficit scale equals a metals tailwind. I like names that are still in the land world, the hedge of tomorrow thesis that we have talked about, and I will lay out later today in the final hour. That is accelerating and continues to just showcase the fact that the ongoing monetization is really the key story here, and I don't really see gold and silver slowing down for at least the next 2 to 3 quarters. So setting up into year-end, liquidity from the RMP will support the markets. Support is the key word. It's going to try to support it. There may be some challenges ahead through April, but then the Treasury General account rebuild will end. That will be somewhere around April 19th. That is the third Friday of April that will be in focus. And then the QT forces will reassert. A lot of corporate refinancing waves next fall. This is all the money that was borrowed during COVID at 0%. That's going to need to be refinanced. That's why the Fed is really, some of these people who are very dovish are trying to get the Fed funds rate down, trying to get borrowing costs down. I don't think they're going to succeed. The market is stretched, but it's buoyed temporarily. And this Fed meeting will become a historical inflection point and will define the Powell era. All right. Sorry about that. We're done. I promise. 9:07. Where are you, Charlie? We just went way too long, didn't we? All right. Congratulations to Conquer for seeing silver moving higher. Brett's here talking about Pete. We'll find out what that means. Could mean anything. That's not weird at all. All right. Don't call it QE. Secret Agent Charlie is here. He's excited. I'm going to add a name to this list. And I'm going to start right here because I didn't add it. And that's this. What the hell is this? Well, if you ever go to Padonia Pool in Lutherville, Maryland, Padonia Swim Club, it's where Michael Phelps got his start at the young age. They have named the pool after him, or at least the lap pool after him. My daughter swims for Padonia, and they came in dead last every single run, so it seems that Michael Phelps is the only good swimmer who came out of there. But if you go there, there is a pool bar, and it's a great pool bar. But somebody will corner you. I don't remember his name. I think it's Steve. He will corner you, and if you let him, he will tell you all about domineering holdings. He will tell you about this to the point that it almost becomes a need to call the police. 2.5 hours I got one summer afternoon about domineering holdings. And domineering holdings, I believe, was an agricultural company. I completely checked out of that conversation at one point. But that said, not to be mean, but the reality was he has done this to everyone in the Timonium area of Maryland, apparently. Anytime that I say, hey, do you know this guy? They go, yeah, did he tell you about domineering holdings? Okay, well, anyway, the point that I'm bringing up here is that domineering holdings is not a company that is making ingredients anymore. They are a bank. They are a bank. Okay. They are a bank, and they are very tied to the Trump sons. They are going to be allowed to do IPOs, and they are working with Eric and Don Jr. And here is your insider buy. Anthony Hayes buying $90,000, and the president buying $96,000. And I found it very interesting that we are seeing these purchases from these executives right now at a time that the Fed is pumping money into the system. M&A activity is starting to pick up. And a little bit more on that. The stock is in a momentum phase at the moment after its recent sell-off. 450, it has popped back above its 20-day EMA, and I'm just going to tell you this. This is a company that is protected up on high. It is protected up on high. 450 a share. It hit 7. It was nothing back here when we had this negative event, 326. It took us all the way up to 840 after some positive news, and we are coming out of oversold. So, yeah, I'm going to buy some domineering holdings on a spec, basically an insider tied to K Street. That's it. 422 is my stop for this stock. I am not going to be shocked by too much news here, and they have authorized a special cash dividend of $10 million. Congratulations to the Trump sons for their winnings. All right, we're looking at TSM. As well, on our breakout side, TSM has been improving, stronger momentum. Semiconductor stocks, look, this stock is going to trade heavily on the geopolitical news right now. There is a lot of tension going on. There was that report that came out suggesting that the United States and China would basically engage in mutually assured destruction over Taiwan. This is going to remain a key story moving forward. But TSM has been and will be one of those names that is at the center and the core of the ongoing weakness in NVIDIA. So Stronger momentum, stronger breakout moves. I like this stock, but what I would prefer to do, of course, is to sell spreads to the downside, looking to sell down near the 270 level and buying around the 260 level. So going out maybe into January, possibly even into February. I'm not going out to March. I'm not going out to April, where there is a possibility of some spasms when it comes to the repo market. But I want you to keep in mind something that's very important. This news that the Fed is engaging, and this is not purebred quantitative easing. This is maintenance, however they want to define that. That is support. That is range-bound trading. That is where I am happy to change my strategy up a little bit, not looking for massive upside, looking for an 80% probability of profit, 20% return, 100% gain by selling spreads to the downside, looking to be able to try to take advantage of that support. And, of course, all of these key moving averages. If the stock does break lower, I can manage that trade. But I'd rather sell spreads to the downside than buy a stock right now that, again, is under some geopolitical pressure. Intel, continuing to Intel. INTC has been very strong coming out of that short-term bottom in November as well. We are stretched on momentum in the broad equity markets, but you can look at these key EMAs and you could see that the 8-day is starting to crack a little bit. Same thing here. I'm looking at Intel from a strategic perspective and what the U.S. government is doing and what is happening in these broader markets, selling spreads to the downside. And you can go down to the $33 level, which is that 100-day moving average, looking for an 80 to 85% probability of profit, 15% gain, and moving on. What was the name of the insider? The insider name is Dominery Holdings, Anthony Hayes, and Kyle Michael Wool. This company is very tied to the Trump administration and to Eric and Don. They are on the board. I found it to be a interestingly timed purchase, given the fact that there have not been executive purchases going back since 2023 or 2024, when they had not made all of these changes and put the Trump sons on the board. PCT and Pony are in focus as well. Pure Cycle. This company, once again, you want to be watching and paying very close attention to this 8 and the 20-day EMA. This thing has moved very, very quickly in momentum moves, moving above that 50-day EMA. You saw what happened in April last year. And if this is a positive inflection point and this is a period of time that we can get off the mat, you could see these are lagging indicators, RSI, MFI, MACD, and ADX, but they're moving in tandem. And this is a matter of buying the stock at $9.40 and simply setting a tight stop back at $9. If we get momentum, we get momentum. We can push back. We'll probably hit some resistance at that 50-day EMA. But you go back to May, you look at some of the way this stock has moved when it has gotten within these ranges, within these EMAs. This thing can break, and we'll look for the behavioral patterns of behavioral traders following those types of lines and see if we can get a breakout on PCT. Pony, I don't know what that is. Is that a song? I don't know. Lot of focus, a lot of pressure here. So looking for some strength here, but once it wants to wake up, you kind of get that sense, don't you? Don is still suffering, I believe, from any reference to ponies after our conversation yesterday. He learned a little bit about what happens in Baltimore. Yeah, just waiting for that commentary. Just wanted to see. Pony is a character from The Outsiders. Sure. It could be Genuine. Was it Genuine who sang Pony? That's quite an R&B song. Pink Pony Club, Wild Horses by the Stones. Got some pony songs. Back in the Saddle by Aerosmith. Don, play a pony song this morning. I think everybody would really enjoy that. To the downside, Sport Trader Group. Ciara, Ride. 15-minute chart. Ugh, that's ugly. To the downside, we're oversold on the 15. So I'm going to scratch this. This is something that I don't even know what this is. Want to see it break under that 50. So that is 22.89. Horse by Salvatore Ganacci. CPB. I'm not betting against this S-Bulk. I know that this came up, but I'm actually looking for this to recharge. The shipping stocks have done very, very well this year, and this just looks like a temporary pullback. If S-Bulk hits the 100-day, buy it. Don't stop buying it. Save a Horse, Ride a Cowboy by Big and Rich. I could do this all day. Doesn't mean that I should, but Campbell's. Ugh. It doesn't get any worse than this, does it? Can it get worse for Campbell's? Can they somehow do worse? Enterprise value, $15.5 billion, massive debt to equity. You think this company needs a rate cut? Ride With Me by Nelly. Okay. Old Town Road by Lil Nas X. We're just talking about songs with horses now. We're talking about pony songs. Not, what are we doing? White Horse by Taylor Swift. Are you tired yet? Have you had enough? Netflix, Oracle, SVXY. Look, SVXY is going to be the one chart you need to keep open all day. All day. And pull up that 3-minute chart, pull up that 5-minute chart, and just watch. SVXY is the short-term futures ETF for the VIX. And some people use different tools. Some people will look at VIX futures. I just like to watch this because I know this is what retail is trying to trade. This is what retail is focused on. So we saw the SVXY have a nice little pop yesterday, and that was resultant of the Fed meeting, the Fed statement. Now, what we want to watch is we'll pull up volume-weighted average price, and if you pull up VWAP and you type in the SVXY, and if you are in a trading session and you set up your anchored volume-weighted average price to the close of yesterday, which is what we can do, and you keep an eye on two things. If the SVXY breaks above its volume-weighted average price, the blue line, and stays above that anchored VWAP, that's positive for almost everything for today. But if it starts to break down, starts to go the other way, breaks through the previous close, breaks through this lower volume-weighted average price, that is your invitation to take a shot to the downside. We are in a very stretched environment. It doesn't feel like it because the RSI and the MFI of the S&P 500 look fine. Yesterday's pop, very low volume. But we have a lot of things that could potentially make this market a little bit tricky. Watch volatility. Not that complicated. Not that complicated. And if you must, Mr. Ed, I'm going to have to go with White Pony by the Deftones. How's that? Deep cuts. All right, everybody, it is 9:20. That means Don is going to come on and pretty much make fun of my jacket, the city of Baltimore, and most of my commentary for the last 6 minutes, and I'm fine with it. If you are not a member of TheoTrade, remember, now is the time to be in these rooms with us. You can name your own price. You could be with us for your first month. And the key thing about this is there is a lot going on in the next 20 days that it would be foolish not to get the insights of multiple experts who have been doing this for way too long. Some of us have been, I think there's one guy who's been trading longer than I've been alive. I'm not going to name any names, but I'm going to tell you this. We've got a lot coming up. We've got Third Friday, triple witching next Friday. Very important. You have the Bank of Japan. You have a low volume week leading into the New Year's with lots of possibility of capital rotation. And then that first week of the year, where is money flowing? You have to be on top of this. So once again, name your price. Join us in the room. We go all day, 8:45 until 4 o'clock. Matt comes in, does the last 15, 20 minutes after the day to answer questions for our members in our community. What are you doing? Give this to yourself. Make it your holiday present. I thank you guys for your time today. You could be doing a lot of things at 8:45. You spend it with me. I appreciate it. You spend it with our chat and build the community that we're continuing to build. I'll be back at 3 o'clock, and Don is up next with a song about ponies. Have a good day.
Hello, I'm Johnny Cash.